So what is the stock that I am actively selling puts on? That is Amazon. Amazon is an absolute beast. There's no need to go into any introduction of Amazon. Everyone watching this channel uses Amazon in some shape or some form. And I'm going to walk you through my OGT intrinsic value indicator, which is an earnings multiple indicator, which then you can work out the intrinsic value, Amazon or any stock that is profitable, that has earnings, to be able to decipher when is the right time to buy into the stock. So first thing we're going to do, we're going to just look at how to install the indicator. You need TradingView. It's a TradingView indicator that is built for. You can get TradingView absolutely free. Link is down below to create an account. And the indicator is free as well. So if you just go across to indicators, type in OGT intrinsic, and you'll see here done by One Glance Trader, of which we've got 223 people that have liked the indicator, which is absolutely fantastic. So when you load the indicator, there will be some preset filters inside there. But let me just walk you through how to do it, because there is some inputs you need to give to create a chart view like that and this table. So we'll go into those once we've had a look at the inputs. So the first thing to really look at is the EPS. So what this does is looks at the trading 12-month EPS, and you want this number to be positive. So like I mentioned at the beginning, if the stock doesn't have any earnings, it can't work out what their EPS growth is, because you can't times the number by a negative. So what we want to do is make sure, firstly, that we have a profitable company. And again, it's not financial advice, but you shouldn't really be investing in stocks really that have negative earnings, especially ones that you want to hold for the long term. So the first thing we're going to look at, we're going to look at the inputs. We're going to ignore all the colors and stuff, which you can play with to your heart's content. There are three main key areas to make this indicator work. One is their earnings per share annual growth rate over the next 5 years as a total. And on average, what is their annual growth going to be? The second one is your annual return. And the third one is the price to earnings ratio. So we'll take one individually and where I would look to go get this information from. So what we need to understand is how much of Amazon's earnings per share is going to grow. So what is that earnings multiple growth on average over the next 5 years? Now, you can use Amazon Finance. They've got an EPS section in there where it gives you analyst estimates based on the next 5 years, and then you can work out what analysts are saying. There are many things that you can use. You can even use ChatGPT to pull that information for you. So to keep things simple for this video, I use Everything Money. Again, it's a paid for service to do that. And what Everything Money does is they've got a tab called Analyst Estimates, which basically tell you what the year-over-year growth is for the next 5 years. Now, again, you can eyeball this and work out what that average is going to net out, or you can calculate it. I just look at it here. So again, you've got the highest month of 30% with the lowest month of 20, ranging pretty much probably around 17 to 20% on average. So what we want to do is we want to put in assumptions. And again, for each one, you've got a low, medium, and high assumption that you can put in. So again, I've gone with, I said that was about 17 to 20. I've gone with the lower 15, mid of 18, and a high of 20. So that's what I've gone with. So what it's going to do, if you look at this table on this side here, is that it takes the current earnings that is behind the screen, and then for the low assumption, it will assume that it's got a 15% growth rate for the next 5 years, 18 for the next 5 years for your medium assumption, and 20% assumption for the next 5 years for your high assumption. So that's how it calculates what your earnings per share in the future is going to be. Then I'll go into annual return at the end. Let's then look at the PE ratio. So the PE ratio is your price to earnings ratio, right? So if we know what the ratio is, we can calculate what should be the price for each given years. Now I've gone for 20, 25, and 30 in my example. What I like to do is if you Google PE ratio Amazon, macro trends generally comes up first for most stocks that you do. Again, this is a free service. And what you want to do is you want to go down here to PE ratio. So this gives you the PE ratio now since 2012 to month to date or November. Now, again, you can ignore random spikes like this. And again, you've got a negative one here. If I can even do it. Their PE ratio is 0 because they had an EPS that was negative. So therefore, there is no price to earnings ratio. I like to just look at the last like few months here just to see how things are going here. So if I look at like the highest is, I think we've got a 50, got a 39, got a 30. So around 50 to 30 is the range of where it's currently looking at here, which isn't unrealistic for a growth company like Amazon. Again, you want these numbers, the lower the numbers, the more conservative you're going to be inside your assumptions. So again, we had 30 to 50. I've gone with 20, 25, and 30, just to, again, be worst case scenario. So what this does, if we take the low assumption for 20, it will then divide, or in this case times, because that's the way it works, is 7.08 times by 20 gives you the year one intrinsic value of the company, year two, year three, year four, year five, right? So that's how it works, right? To get this intrinsic value. Now, the last piece is your rate of return. Now, to find the true intrinsic value of this company based on your assumptions, if these assumptions pull true, you need to put this number to 0, and we'll simulate that shortly. So what generally I like to do when it comes to annual rate of return is it's your margin of safety. It's how much return you want to make per year holding the stock. Now, the S&P 500 does around 8 to 10% a year. I always do 8%. And the reason why I do 8% is because I'll be doing some option strategies, selling covered calls, doing all that other stuff to juice out an extra 3-4% a year. So I actually don't mind getting in at a slightly lower intrinsic value, so to speak. So again, the higher the number, the lower your intrinsic value is going to be. So therefore, the stock has to drop lower to get into your range. So again, I generally go for 0, and the higher the number, the lower it will. And if you put this to 0, it will push everything up because it just assumes that there's no margin of safety inside there. So what this does is then, if we look, and this works backwards from year 5 to get to year 1. So again, if we look at the low example as an example, is that, so it's taken a 15% earnings multiple growth rate. It's taken year 5 and times it by 20 to get your year 5 price of $247.40 as your intrinsic value for year 5. And then what it does is backwards re-engineers and divide and takes off 8%. So it will time again by 20 and then take off 8% of every single number to then lower that number down to your desired intrinsic value for year 1. So that's how the indicator works. So if I hit OK, what that does then, it gives you 3 lines, your high assumption line for 5 years and your medium assumption and your low assumption. So based on this, let's go with the low assumption for now, is that your low assumption that the intrinsic value based on your earnings growth rate, your PE ratio, and your desired rate of return, that if you wanted to buy Amazon today, you would want to buy it below or at $181.84. So that's the kind of price where you want to do it. So this is how powerful this tool is. And again, you can play around with the numbers so you can see what different permutations gives you. And based on my calculations that I've put in, again, mine are more conservative than the analyst estimates, and I've done lower PE ratio. So if anything, these figures are probably a bit higher than that, right? But if we're playing worst case scenario, I call this the golden zone, in between your low and your medium assumption, assuming that you've been conservative with your numbers that you put in there. So what this means here is trading at 237.88. It is below your medium assumption. So if you assume your medium assumptions of an 18% annual growth rate in your earnings, a PE I think was 25, I think it was, with an 8% desired return, you should be buying Amazon stock, assuming everything else fundamentally you're happy with in terms of the company and all that stuff. So this doesn't look at fundamentals in terms of its return on capital employed, its balance sheets, its free cash flow, all of that kind of good stuff. This purely just looks at its earnings multiple and what is the right price that you should be paying based on the return you want to get. So what would I do in this scenario? So what I've been doing actively is selling puts on Amazon at around the 180 strike. Now, and the reason why is it's not too far away from 180, right? So therefore the premium will still be pretty decent. And then even if it doesn't get to 180, the option will expire worthless. I'll keep the premium. If Amazon goes up, again, it's not my assumption anyway. So therefore, if it goes up, stocks go up, it doesn't ever hit your assumption. I get all of that. You don't do anything there. Or the third option is that if it falls through this, I either roll my option or I get assigned the shares of 180 or whatever the strike price that you want to do. Ideally, your strike price wants to be lower than your lowest assumption. What you could do if you've got a fear of missing out, you could sell the 180 strike And then the premium that you collect, you can start buying Amazon shares that in case it does take off, you can use that premium to go buy Amazon shares, because at least then you're in your kind of golden range between the low and the medium assumption. So let's just have a quick look at to see what strike prices are and what the premium we can get. So what I like to do is, again, I've just gone Yahoo Finance options change for Amazon. I'm looking at the puts only. I like to go out between 45 to 60 days of the monthly cycle. So the closest monthly cycle as of recording this on November the 14th is the January 16th cycle. So again, we were looking at the 180, I believe. So the 180 strike. So if I go to the 180 strike, I'm getting around 88 cents per share. So options contracts are in contracts of 100 shares. So that'll be around $88. And again, they're $5 strikes here. So if I wanted to go a bit more conservative and do the 175 strike for $73. Again, depending on how many contracts and lot sizes that you're doing, for me, this would probably be a kind of like a 2 lot. So again, we're looking at about $180 odd or just around that when you take into account commissions and fees. So what I would do is take that $180 odd and I would go and buy shares of Amazon at the current price, which at the current price of $237 is just under one share that I'll be owning. But at least then I've got some skin in the game of Amazon. And if Amazon goes up or stays the same or doesn't get anywhere near 180 at the day of expiration, the best case scenario, in my personal, is that it does drop slightly into the 190s or something. Therefore, I will sell again the 175 maybe, which therefore that premium could be $1 or $100. And therefore, if I sold 2 contracts, that would be $200. And therefore, I'll go buy $200 of Amazon. So therefore, I bought 0.8 shares, and then I bought basically one share. It drops to 190. Therefore, I'll have 1.8 shares at a cost basis of 195. I don't know, whatever it's going to be. My point being is that I'm utilizing the premium to buy shares in a stable company, a strong company that fundamentally is strong and is getting closer or nearer around my assumptions. So I said I was going to have a quick look at if we put the intrinsic value to 0, right? And again, this is going to push the lines up, right? So again, you can see here that the intrinsic value, even on your low assumption, is $247.40. So it's actually below your low assumption. So assuming that the rate of return is non-existent here, that the pure intrinsic value price of this with no margin of safety, you should be buying Amazon at 237 or any, because it's the intrinsic value is at 247.40. So hopefully that makes sense in terms of how to do this. Again, you can do this on any profitable stock, Tesla, Google, Nike, Apple, whichever one you want. You can do this on. Again, utilize the earning per growth calculators. There's so many of them out there that you can get these figures on and go below those numbers. And again, go with a desired rate of return, 10%, 15%, whatever you want to do to go down low enough to make sure that you're getting a decent stock at a good fair valuation. So hope you've enjoyed this video, and I shall see you guys in the next one.